I'm Reena Aggarwal. I have a couple of hats on here at Georgetown University. I'm the Robert McDonough Professor of Business and Finance and Director of the Georgetown Center for Financial Markets and Policy. I'm also Georgetown's Vice Provost for Faculty. Welcome to all of you to Georgetown University. We are absolutely delighted to have you here. Just a gentle reminder, maybe you want to turn your cell phones off or put them on vibrate or something like that. We are delighted to once again partner with the Financial Times to organize today's conference on financial markets quality. Georgetown's McDonough School and the Center have regularly partnered with the FT, and each of these annual conferences that we have done have been in partnership with the FT. As many of you know, Georgetown University is one of the world's leading academic and research institutions, offering a transformational educational experience that prepares the next generation of global citizens to lead and make a difference in the world. The mission of the Georgetown Center for Financial Markets and Policy is to provide thought leadership for global finance. The center offers innovative, influential, and thoughtful commentary. We conduct relevant research that impacts practice and policy. Our mantra is excellence in research to impact practice and policy. Being situated in Washington, D.C., this is an ideal location to do what the center is best at doing. We host dialogues and conferences that involve scholars, practitioners, policymakers on key financial market issues. Through these activities, the center contributes to an informed, solutions-oriented discussion regarding critical issues faced by the global financial markets. We really do believe that it is the responsibility of Georgetown to provide unbiased analysis that can both guide market participants and help policymakers. We are not an advocacy group of any kind. Our analysis is completely unbiased. We bring academic rigor to whatever events we organize, whatever issues we address. Just to give you an idea of some of the center's activities, earlier this semester, the center held a Careers in Capital Markets event for our students. This room was packed with standing room only. So we are certainly taking care of our students and helping them to think about careers. As many of you know, there's been quite a bit of finance bashing that has happened in recent years, and there really is no better place than Georgetown to get the word out that finance is really for the good of society. Finance is not just for the 1%, the top 1%. It really is about impacting everything from poverty, financial inclusion, health issues. If we don't have the financial structure working, none of those issues, those complex issues, can be taken care of. And I really believe Georgetown is very well positioned to have those complex conversations. Recently, the center completed a report in partnership with the World Economic Forum on the complex regulatory landscape for fintech that was actually done by our students. And that report has received kudos from all over the world, not just the US, but all over the world. Our students provided an in-depth analysis of fintech regulation in the US, in UK, in China, and that's going to help guide policymakers who are trying to figure out how should regulation look like for fintech. We are a partner with the Digital Chamber of Commerce on blockchain issues. So there's a lot going on here at Georgetown and at the center, and we're keeping quite busy. it is our commitment not just to educate our students, but also society at large. We are located in Washington, and I think of Washington as not just the nation's capital, but this is the city, it's a global capital. And we become the go-to place, and we have the ability to convene people from business, policymakers, and academia when important issues need to be resolved. Our events tend to have strong participation from both the private sector and government agencies such as the SEC, CFTC, Capitol Hill, Treasury, White House, IMF, World Bank, the embassies. For example, we've been doing this conference on financial markets quality for several years now. And part of the reason for doing it is because there's been a demand from the market. We've been asked that please keep doing it, that the conversation tends to be very thoughtful here. So today, we're going to hear about a lot of issues. We're likely going to hear the words ETFs and ETPs quite a bit. And this came up, excuse me, these issues came up last year also at the conference. I just want you to know that Georgetown is doing some in-depth work on ETFs and ETPs. We are taking up this big study looking at both the cash market aspect of ETFs and the securities lending aspect of ETFs. It's interesting to see that the demand to borrow ETFs is extremely high, but somehow the lendable inventory is quite limited, which makes the fee extremely high. This market is very different from what we've studied in the equities market, in the corporate bond market, in the sovereign bond market, and there's very little academic work that has been done on ETFs, so Georgetown is taking up this big study. I want to make sure to thank our sponsors, our participants, NASDAQ, BATS, New York Stock Exchange, Convergex, Invesco PowerShares, State Street, T. Rowe Price, BlackRock, PIMCO, Gabelli Funds, IEX, Morgan Stanley, and many others who have contributed in different ways to make this conference hopefully a huge success. I also want to thank ETF Global for helping us with ETF data so that we can do the study that we have planned. I want John Jacobs to please stand. John, you're here somewhere. In the back, okay. John, I guess, is partly known as Mr. QQQ, and he recently joined us after a long and wonderful career at NASDAQ. We're absolutely thrilled to have John on our team, and today's event is possible largely due to John's efforts. The person that's really responsible for pulling this all together is Jessica Dybfest, the Assistant Director of the Center, and thank you to Jessica. I also want to thank our Marketing and Communications Office here at Georgetown, Chris, Teresa, Naluka, Bryn. Thank you for all your help. And of course, my finance colleagues who are here in the audience and who help in many different ways. So we have a terrific set of speakers. We're going to learn a lot. I hope the conversation will be a meaningful conversation. We'll think about some solutions to some of the challenges that we face. But as we discuss those, let's keep in mind that the US financial system is the envy of the world. Our financial markets are really the envy of the world. Other countries would love to be where we are. So as we continue to strengthen our markets, we must not forget that there's a lot that is working very well. So again, thank you, and welcome to Georgetown. I'm going to hand it over to Professor David Walker to introduce Commissioner Piwowar.
Good morning. I'm a longtime member of the McDonough faculty. I won't bore you with how long, but our keynote speaker reminded me that we first worked together 22 years ago. Having a career in a top university allows unique opportunities, and we should never forget the freedoms that we enjoy. My greatest pleasure at Georgetown is to work with students with infinite potential and with distinguished colleagues. I'm privileged to introduce our keynote speaker, Dr. Michael Piwowar, Commissioner for the Securities and Exchange Commission, which has shattered its record for the number of enforcement cases in the past year. Michael was a research colleague of mine as a Georgetown MBA student 22 years ago, and he has become a distinguished public servant, as you know. Michael sacrificed to earn experience in academia and numerous public policy positions, which motivated President Obama to appoint him as a commissioner in 2013. After earning his MBA here and his PhD from the Pennsylvania State University, Michael taught at Iowa State University in Ames and served in senior public policy positions with the U.S. Senate Banking Committee under Chairman Richard Shelby, whose wife Annette was a colleague of ours at the McDonough School for 20 years, retiring a couple years ago. And then Michael served as a senior staff member with the White House Council of Economic Advisors. Michael is a leader in the financial world and is an expert on Dodd-Frank provisions and an accomplished scholar on market microstructure issues. He brings a unique perspective to us. He's extremely generous with his time, presenting policy lectures in a wide range of forums and meeting with Georgetown students to provide them with insights from his experience. Michael, thank you for joining us to begin this wonderful conference, and we're delighted to have you back every and any time that you can join us.
Welcome back to Georgetown.
Thank you.
But first, we have a few very important housekeeping announcements. I want you to pay close attention.
Yeah, the first one is for any of you that have ever seen anybody from the SEC speak, you know what's coming next, the disclaimer, right? Any views I express are my own, do not necessarily reflect the views of anyone else at the commission or my fellow commissioners, and if we get into something controversial, oftentimes do not reflect the views of my fellow commissioners, so we'll see what we get into. I also want to take the opportunity to thank Reena for inviting me back here. As she mentioned, the mandate for the center is to provide excellence in research that is relevant to policymakers. And as a former academic, I can tell you that they check the first box. They do high-quality, rigorous financial economic analysis. And as a policymaker, I can tell you they also check the second box as well, too. It has become a go-to place for me to get policy-relevant, excellent, objective research. And then finally, I want to thank David Walker for that very, very kind introduction. Yeah, it was 22 years ago when I was a research assistant working for Professor Walker, and I walked into his office, and I said, I think I want to get a PhD in either economics or statistics or something like that. And he said, well, what about finance? And I said, well, what does that have to do with economics and statistics? And rather than laughing me out of the office, he sort of very quietly explained to me what finance was just a branch of economics, and that was one of the paths along my career that ended up where I am today, and I'm very thankful for Professor Walker and everybody else at Georgetown.
Thank you. So, Michael, what are the important market structure issues facing the SEC today?
There's a whole host of issues, and I think we're at a unique time at the Commission where we can actually take some time and step back and take a more comprehensive approach to market structure, particularly in the equity markets. Our equity market structure is very, very complex, if you want to boil it down to one word. And folks have identified a number of issues that we think we want to look at in terms of the market structure. And rather than sort of taking them on a one-off basis, and if you think back to what we've done over the last about 6 years, thinking back to the flash crash of May 2010, what the Commission has done is sort of been in reactive mode in terms of various trading glitches or various books that come out that question whether or not the markets are rigged. and various other algorithmic changes in the market, changes in technology, all those sort of things. We've sort of done a piecemeal approach, and I think there's an opportunity for us, now that we've solved a number of those problems, that we can take a more comprehensive approach and look at the overall structure of the market, which has changed dramatically in the last 10 years because of regulation NMS. And at a very minimum, we should take a retrospective review of regulation NMS, which changed the market dramatically in ways that, like my former colleague, Dan Gallagher says, it effectively mandated high-speed trading in the market, if you think about it. And so there's a whole host of issues we can look at. We have a Market Structure Advisory Committee, which is a group of outside people, academics and market participants, who've put on our plate a number of issues that we could look at. If I was chair, if I was a benevolent dictator for a day, what I would do would be to set out a plan for folks to look at all aspects related to the market structure and then unleash the force and power of academics throughout the country at places like the center here at Georgetown to help us think through all these issues very, very comprehensively before moving sort of on a piecemeal approach, and then it would be a multi-year process, but it would be one I think that'd be fruitful in the end.
Well, I think you would make a really great benevolent dictator. Let's push that one step forward. Let's suppose you had the ability to restructure not just the SEC, but our entire regulatory system.
Right.
You may recall before the financial crisis, there was the Treasury blueprint and a lot of talk which basically never really went very far. So if you could restructure our whole regulatory system for financial regulation, what would it look like?
Sure. In one word, it would be simpler. Right? We have a highly complex regulatory system. If I were to quiz you, everybody in the audience here, to come up with a list of all the financial regulators in the United States, I bet most of you couldn't come up with a list. And Dodd-Frank not only didn't make it simpler, it actually made it more complex. Right? We got rid of the Office of Thrift Supervision. So we got rid of one, but that was folded into the OCC. But they were recidivist back from the savings and loan crisis, so they had to go. But Dodd-Frank also added additional regulators as well, too, the CFPB, the FSOC, the OFR. I travel internationally and talk to regulators in jurisdictions all over the world, and the dominant conversation or decision they have is whether or not they want to have a single regulator or two regulators. We have something close to 20, and if you add up all the state securities regulators and the self-regulatory organizations, you're probably close to 100 different regulators in our space. They talk about either the single peak model where you have a consolidated regulator or a twin peaks model where you have a prudential regulator and a markets regulator. We have what I refer to as the rolling hills model. In my view, I think the Twin Peaks model has a lot of appeal, and the reason for that is prudential regulators and market regulators have fundamentally different missions and have fundamentally different views of the world. If you think of prudential regulators, banking regulators, for example, their role is to think about safety and soundness of the banks, of the institutions under their purview. Markets regulators are, at the SEC, our mission is protecting investors, maintaining fair, orderly, efficient markets, and facilitating capital formation. And our ways of dealing with certain situations are very, very different. Whereas banking regulators would like to have very, very complex type of capital requirements, let's say on balance sheets of banks, and do things behind the scenes, market regulators, our answer is let's use our disclosure regime to give information to investors to make informed investment decisions. That will translate into prices into the market. That will then give signals back to the regulators about what to do moving forward. So I think that would be the preferred approach.
Thank you. Now, you mentioned a lot about equity market structure. What about fixed income market structure? Isn't there more work to be done there than in equities?
Absolutely. And I think at the end of the day, in terms of bang for the buck, in terms of additional dollars of resources at the commission, I think would be better spent in the fixed income markets for a couple reasons. One, if you look at the spreads in the fixed income market, they're actually quite high compared to equity markets. When I came to the commission as a researcher about 16 years ago, about 14 years ago, I had been studying the equity markets, and then I started studying the fixed income markets. A couple things jumped out at me. One, just how high the spreads were in the fixed income markets. And two, if you plot transaction costs as a function of trade size, in the equity markets, the larger the trade size, the bigger the transactions cost. In the fixed income market, it's the opposite. And what so that suggests is that institutions are doing quite well in the fixed income markets, while retail investors were not. The Commission embarked on a number of initiatives to add post-trade transparency to the market. So now when a trade occurs in either the corporate or municipal bond market, investors can find that information. And since I've come back to the Commission, I've tried to refocus us on looking at the fixed income markets in a number of initiatives. One is to add best execution requirements in the fixed income market. We had it on the corporate side, but not on the municipal bond side, so we've added that. Working with FINRA and the MSRB, the self-regulatory organizations, to add disclosures of riskless principal markups on customer confirmation sheets. So if a trade is done on an agency basis, the commission is included on the confirmation sheet, and the investor knows exactly what price they paid for the bond plus what commission they paid. If it's done on a markup basis, that's not as transparent. And so the MSRB and FINRA are moving towards giving that information to investors. And then the third piece is thinking carefully about how we can improve pre-trade transparency in the fixed income market as well, too. There's a number of business-led initiatives, market initiatives that are going on in this space. Our staff is carefully looking at that and determining whether or not there is a need for government intervention in this space, or should we just sort of let the market sort of evolve in this space. We're seeing a couple trends that are pushing towards that. One is the improvements in technology. We see a number of alternative trading systems coming in that space. There's going to be a lot of competition. There's going to be a shakeout of that fairly soon. And then we see also the provision of liquidity in the fixed income market is changing. Dealers, the traditional providers of liquidity, dealers have smaller inventories, are becoming less of the traditional providers of liquidity. And what we're seeing is the buy side, the asset managers, the BlackRocks, the Fidelities of the world, are not only sort of the buy side, but they're sort of filling in some of the sell side role as well too, in terms of providing liquidity for themselves and some of the other buy side, and that's where the alternative trading systems are stepping in and trying to provide some of that added liquidity in the market as well too.
Now, one of the problems in the fixed income world is, as an investor, one never really knows what's lurking deep in that bond indenture. BlackRock and others have called for more standardized approaches with standardized bonds, and one thing the SEC could do is to provide faster approvals for bonds with standardized documentation and more rigorous, slower approvals of non-standard documents. What do you think of that idea?
Yeah, I mean, this complexity in the instruments, right? So BlackRock has obviously mentioned it sort of in the corporate bond space. I mentioned when I was a researcher at the Commission, when I came in 14 years ago, I started looking at the municipal bond space. And one of the things that struck me was that how complex those issues are. First of all, municipalities don't issue one single bond. They issue a series of bonds, a 1 year, a 2 year, a 3 year, all the way out to 30 years. And if you look across those series, those individual CUSIPs, you see that they very much differ in terms of the features that they offer. Some of them are callable, some are not, some have sinking funds, some do not, some have super sinkers, some have non-standard payment systems. And it struck me and my colleague, Larry Harris, who was the chief economist at the time, that it seems like there's something overly complex here. So we just looked very simply at controlling for everything else. How costly is it to trade a more complex bond than a simpler bond? And we found that, in fact, the more complex the bond was, the higher trading costs that individual investors paid. And it was particularly higher in the retail space. So what we gleaned from that was that institutional investors are very good at looking at, trying to figure out what the value of the embedded options are and what the real price of those bonds are and those sorts of things. But retail investors, it may be, it's a lot more difficult. So I'm not sure what the right answer is. I've given a couple speeches recently where I've reached out to folks in the municipal security space and say, why are they so complex, right? And I've gotten some answers is that it has to do, in some cases, with tax issues. It has to do, in some cases, with budget issues, state laws, and those sorts of things. But it doesn't explain why it's overly complex in that space. And it's an issue that we're still grappling with. With respect to the standardization issue that BlackRock brought up, from the investor side, yes, it seems like it would be much better to have more standardized issues. And one example would be, a company issues a 10-year bond today, and then 6 months from now issues another 10-year bond. They're not perfect substitutes for one another, right? But however, if the issuer would issue a 10-year bond today, and then 6 months from now issue a 9-year and 6-month bond, then they would be perfect substitutes for one another. And it seems like from the investor side that would be better. There would be more substitutes. There would be more liquidity across these issues. But for whatever reason, issuers don't seem to be moving in that direction. And so the question is, why is that? Is it something regulatorily, to your point? Is it the speed of approval in this space? Or is it just something that issuers just having 10-year issues and not having everything mature at the same time and having to roll over a bunch of debt and those other types of things? So that's something we're continuing to look at to see whether or not there are any regulatory impediments to this, or is this just a feature of the market that reveals certain preferences for the issuers?
Let's move on to ETFs and ETPs, other exchange-traded products. The August 24th demonstrated that they didn't always track their underlying net asset values. Can you tell us more about what the Commission's doing with exchange-traded funds and exchange-traded products, and what the regulatory trajectory looks like for ETFs?
Sure. As Reena mentioned in the opening statement, we're the envy of the world in terms of our capital markets, and one of the reasons is we have a lot of good innovation that's benefited investors over the years, and ETFs are an unqualified success in terms of allowing investors to invest in a whole host of different securities, a whole host of different sectors, and all those other things. ETFs, generally work quite well 99.99% of the time. However, every once in a while we have something in the markets that reveals that maybe there's something that we could do to make the market structure better. Right after the August 24th volatility event, there were a number of concerns that people had and said, well, maybe it was because of the way that the exchanges had their different opening procedures. But if you look at who was affected, it was ones that were listed on NASDAQ and Amex as well as the New York Stock Exchange, and so that didn't seem to be it. And then people said, well, maybe it was the liquidity of the underlying issues that were there. And so there was a whole host of reasons that people came up with what caused this, and our staff carefully looked through all of these things and it determined that a lot of the stuff that was initially blamed for what was going on was not the cause there. What we did find, the staff looking and also through our Market Structure Advisory Committee talking to us about this, is that there were some changes, some small changes we could make to the market structure affecting all stocks, but just because exchange-traded funds trade a little bit differently, that would affect them. And those had to do with things like aligning when we break trades, clearly erroneous trades, with the bands around the limit up, limit downs. These are when prices deviate from their original opening price, and then we place limits on when they can trade again and whether they can only trade up or trade back down. Changing the limit up, limit down bands themselves. What we found was that there were a number of things interacting where we had the limit up, limit down bands had changed in the morning from later in the afternoon. There were different bands around that, and the clearly erroneous trades bands weren't matched up with those, and if we could do things to match those up, we could get 99% of the way there to try to fix that. And so staff has been working with the industry to fix that, and we'll see what happens next time. We have my guess is that we're not going to have something similar to that going forward.
Now, the news media is reporting that there will soon be final rules on some ETF and mutual fund related activities. Would you care to discuss what might be coming down the line?
Well, I mean, so the chair sets the agenda for the commission. We've stated that we're working on a number of rules in the investment management space, so mutual funds and ETFs together, related to issues that were identified by a number of people about concerns about whether or not there's financial stability or so-called systemic risk issues in the asset management space. I don't think there are, but they've identified a number of issues in which I think the commission should be moving forward in anyway. So we've already finalized rules where we're getting better data from our investment advisors for both public and private funds. Tomorrow we will be voting on a rule to add greater regulatory transparency and public transparency, getting better data from mutual funds and ETFs with respect to portfolio holdings, use of derivatives, and those types of things. We're also moving forward with a final rule on liquidity risk management for mutual funds and ETFs. And we're under consideration we're considering rules right now to look at the use of derivatives with funds, and then also transition plans for investment advisors. I don't think we're going to get the derivatives rule done or the investment advisor transition plan done before the end of the year, before the changeover to administration. I think we're going a long way towards getting better data with tomorrow's rulemaking.
So speaking of the regulatory trajectory, the Department of Labor recently came out with the so-called fiduciary rule. And I understand the SEC is looking at similar rules on the SEC side. Yeah. So would you care to comment on the Department of Labor rule and what the SEC might do?
Sure. It is a terrible, horrible, no good, very bad rule. And then the follow-up question is, well, what does the rule say? And my answer to that is, I don't know. And you say, well, how can you say it's a terrible, horrible, no good, very bad rule? And that's because people have been looking at this rule for months and still can't quite figure out what it means, what it says. It's a very complex rule. There are certain provisions that seem like it blesses so-called robo-advisors, automated investment advice. There are other parts of it that question whether or not it meets a fiduciary standard. Some state securities regulators have also questioned that as well, too. It's a very, very complex rule. We're just now starting to see industry react to that rule. And where it impacts us is it's under ERISA, which is on retirement plans, but where it impacts us or spills over into our regulatory space is registered representatives or investment advisors, mostly registered representatives, who are talking to their clients about IRAs. And so if a registered representative talks to their client about a particular mutual fund, just in terms of investing in a mutual fund, not a problem. But all of a sudden, if you talk about holding that mutual fund within an IRA, now all of a sudden you're subject to the DOL fiduciary duty rule. And it makes it almost impossible for registered representatives to get commission-based compensation and then effectively forces them to move over into an assets under management type base and compensation. And my concern all along is that what we saw in the UK, where they had something not exactly the same, but something very similar, where it forced a movement from commission-based over to assets under management based compensation, that we saw something like 10 million households priced out of the market. What happens is if you raise the regulatory costs to providing something, the break-even point for account balances goes much, much higher. And my concern is that retail investors that don't have the real high account balances are going to be priced out of the market. And if you thought before the fiduciary duty rule they were getting suboptimal advice, and that's questionable, now you're moving to a place where they're not getting any advice at all. And that's what I fear about it. We're just starting now to see how the market is reacting to that. And my prediction is we're going to start to see a lot of people priced out of that market.
Well, we've already seen Merrill Lynch
Yes.
not offering commission-based brokerage accounts anymore to IRAs. So what kind of possible actions do you think the SEC might do in response? Not necessarily what you want them to do,
Yeah,
but
exactly.
What's on the table? What are the possibilities?
Yeah, so there's a number of things. So we have at the SEC, separate and apart from DOL, and some folks have said, well, the SEC should move and we should move to a uniform fiduciary duty, and I'll explain what that is in a minute, to stop Department of Labor from doing what they're doing. Department of Labor was going to do what they were going to do no matter what. Didn't matter what we were going to do. In our space, we have, it's very, very complicated. What we do is we have registered representatives or brokers, which are governed by the Securities Exchange Act of 1934, and provided execution services historically for individual investors. And then you had investment advisors, which is governed by a fiduciary standard under the Investment Advisor Act of 1940 that provided investment advice. Over time, that line has blurred. And registered representatives, brokers have started providing incidental investment advice. They're subject to a suitability standard, and people argue that the suitability standard is much lower than the fiduciary standard for investment advisors. But it's a lot more complicated than that, because registered representatives are also subject to FINRA oversight, the self-regulatory organization, and they have an entire rule book that governs the suitability issues. And I can tell you that the suitability standard has real teeth. We bring enforcement actions. FINRA brings enforcement actions under the suitability standard all the time. Some people think that, well, what we can do is just apply the fiduciary duty standard to the registered representatives and then we're good. But there's a lot of case law, there's a lot of practices, policies, procedures that are put in with the suitability standard that would cause a very, very strong upheaval. Why are people saying we need to move to a fiduciary duty standard? Well, if you look back several years ago, the commission commissioned a study by the Rand Corporation that basically showed two things. One, investors were confused in terms of what standard of care they were under. So if you polled investors and say, your financial advisor, do they have a suitability standard or a fiduciary standard? The average investor didn't know, or still doesn't know, right? So there's some confusion in there. But what they also found was that investors were generally happy with the standard of care that they got. So even though they were confused about it, they were generally happy. The concern is that if confusion leads to worse outcomes, maybe there's a role for rulemaking in the space to get rid of the confusion. My answer to that is, well, if confusion is the problem, in order for us to get to rulemaking, we have to do a couple of things. First, we have to show that investors who are more confused or less sophisticated are more likely to get worse outcomes, right? So you have disparate impacts against certain investors in that case. So then a case can be made that we need to do something to get rid of this confusion. Well, rather than quickly move to rulemaking, I think one way we could do that is think about improving disclosure or improving investor education. So if we can get rid of some of that confusion through an education or through disclosure, simple disclosure documents that say, that they have to provide to the customer that says, you're under this duty of care, this is it compared to this duty of care. I think we can do that without sort of upsetting the historical balance that we've had with the two different regimes.
This week marks a further rollout of the so-called tick pilot. What do you think we're going to learn from that, both from the process of creating the tick pilot, as well as from the actual results of the pilot itself?
Yeah. So I'll deal with the process second. So from the results, we just started it. We're rolling it out right now. It's sort of a phase-in. Not all of the categories or buckets that we call them have been phased in at this point. We don't have definitive results on anything right now. We don't have the trade at bucket trading all the securities yet. We can say that there didn't seem to be any technological problems with the rollout. There doesn't seem to be any glitches. People are adapting to it. And so I'm hopeful that in a few weeks we're just going to start to get real-time data in it. The proponents of the tick size pilot have said that one size doesn't fit all for the markets here. And perhaps if we widen the tick size for small cap companies, a number of things would happen. One would be potentially you get more depth at each price increment and improve the overall liquidity in the market. We'll be able to measure that directly. And my own prediction is we're going to see it's going to benefit some, but maybe not benefit others. So we'll see some cross-sectional differences in that, my prediction. Others have suggested that will allow for subsidization of research, and then we're going to get more analyst coverage and get more research in the stocks, and that will help improvement. That, I think, is a lot more dubious. I'm skeptical of that. The world has changed. The providers of liquidity are not the investment banks that also provided research back in the 1990s. But I could be wrong. What's important to know is that Congress was moving towards legislation that would have mandated that we do it anyway. So even I'm one of the people who's sort of skeptical we're going to find big results, but it was still worth it to do it. One, because Congress would have mandated us to do it, and this allows us to control exactly how we make sure we get a statistically valid study, so researchers like you can actually go in and research and find the results that we want to find in this study. And two, even if it doesn't find the results, it allows us to move on to talk about other issues about how we can improve the market for small cap securities. There's been a whole host of reasons why people say the markets aren't working for small cap companies. Query whether that is in fact true, but if it is true, it allows us to at least get one of those things off the list and we can move on to other things. Now in terms of the process, it is done under what's called an NMS plan, and this is getting into the weeds a little bit, but the way it works is rather than the commission mandating what the study was, what the commission did was told the SROs, the exchanges, to go out and say, all right, you all design a tick size pilot. Now we gave them certain conditions on which to do that, and then they came back and we worked with them and sort of iterated the process in terms of getting to the pilot. An NMS plan type way of doing a pilot program in one way is inclusive, but in other ways it's very, very difficult to get those things underway. We're under active consideration of doing something called an access fee pilot, maker-taker pilot. We've got a recommendation from our Market Structure Advisory Committee, and we can go one of two directions in terms of if we want to move forward with that. One is to do an NMS plan, which is we put together a document that says, all right, exchanges, you all figure out how to do it and come back to us, and we iterate back and forth. The other way is for us just to do a rule change, which requires us to do a lot more upfront thinking about it and then putting out as a proposal for public comment. It requires us to do a lot more upfront work on this, but I think ultimately it will allow us to get to a final point, if we're going to do an access fee pilot, to get to a final point earlier on in the process.
Yeah. What I'd like to do now is open it up for questions from the audience. Does anyone, I see a question over here.
The microphone?
In many foreign markets, collective investments are not subject to what we would call our trading stop rules or our halts at the exchanges. I'm just wondering where the Commission is in looking at the benefit that brings. Because I know, having worked at the Amex, we suggested when NMS first came out that the ETFs not be subject to halts, because of the fact that they're representing the liquidity of all the underlying ordinaries, unless those ordinaries themselves, a certain percentage, had been stopped trading. Has the Commission had any additional thoughts on this?
Yeah, so that's one of the things staff is looking at right now. We're looking into a number of issues with ETF trading. I mean, one of the things we learned from the flash crash going all the way back to 2010 was that, you know, ETFs themselves are securities, but the liquidity of ETFs compared to the underlyings is very different. And the staff study for the 2010 flash crash is excellent. There's some excellent charts in there that show sort of the depth in there. It's because ETFs, what you tend to have is you have a lot of liquidity at sort of the inside bid and ask, but then it sort of dries. There's not much away from that. Whereas securities, you tend to have a lot more depth of those sorts of things. And so there's a whole host of issues that the Commission's looking at in terms of the trading of the underlying vis-a-vis the trading of the ETFs. Somebody up there.
I think there's one up there. Did I see a hand up there?
Hi. Can I ask you a question about, because you mentioned about corporate bond market and related regulation. You know, there are current debate about how this OTC market driven by dealers are affected by now more stringent capital regulation of dealer side. And, you know, some of academics and policymakers, they are debating about whether, you know, imposing tighter capital regulation on dealer actually might have some adverse effect on corporate bond liquidity. Do you have anything to say about this?
Yeah, so there's a lot of good research being done by academics looking at this particular question, and it seems like almost on a daily basis we're getting information from folks looking at various things. And so dealer inventories we know are down, and the question is why. And people have suggested there's sort of two buckets of reasons why. One is structural reasons, so things like regulations like the Volcker rule or the Basel capital requirements. It just makes it too costly for them to hold bonds in inventory. And the other is cyclical, and some people have suggested with the low interest rates right now, given the capital requirements that are there, it's just not economic for dealers to actually hold the bonds. And so that's where, as a policymaker, I look to rigorous academic research from like the center here at Georgetown that looks at these issues. There's some interesting research being done that's showing that dealers, not only their inventories are down, but they're less willing to hold inventory even intraday within the day. So they're committing less capital in this market as well too. and it's not related to things like transparency in the market. So one of the arguments is it's not regulation, there's too much transparency in the bond market, which I find laughable. And so that allows us to say, well, it's not because of transparency. Perhaps it's because of either the cyclical or the structural reasons in the regulatory environment. I think there's starting to be more folks saying that perhaps things like the Basel capital requirements, the Volcker rule, and some of the other things under Dodd-Frank are impinging liquidity in this market. And the question is, from a policy standpoint, what do we need to do, if anything, to quote-unquote fix this? Or, as I mentioned, the changeover in providing liquidity to the buy side, are they able to pick this up, or do we need the dealers as sort of the shock absorbers? Or will the alternative trading systems, the growth in technology, allowing folks to interact more directly, will that have to obviate the need for some of this stuff as well too? All those are open questions, and all those are questions that we could get a lot better information from academics to help us make policy decisions.
Thank you. And we have time for one last quick one. I see a hand over there that's been up for a while.
My question is about ETFs specifically, and is the Commission looking at segregating ETFs by the type they are, physical versus non-physical backed, leverage inverse? Because during the flash crash, a lot of different reasons were given out. So has the Commission looked at segregating ETFs by approvals? If you look at the European markets, velocity ETFs are separately categorized, commodity ETFs are separately categorized from ETFs.
Right, you're talking about the approval process for new
Approval
ETFs?
process as well as the monitoring process from a regulation standpoint.
Yeah, so in the approval process, right now all ETFs have to be approved as, they have to be exempt from the 1940 Act. They're technically illegal if you think about it. And so we have a broad exemptive authority to do that. And we can do it, and we've done it for a number of things. And the way it works is if once a certain class gets approved, then it's easier for follow-ons within that class. However, how you define those certain things are very, very difficult. The other thing to know is that it's still done on sort of a case-by-case basis. It's not regularized. I've been asking the Commission we need to move forward with rulemaking in this space. We could actually do rulemaking that would make it much easier for ETFs to get approved once they've been approved in a particular class that's gone along. And then we could spend our time and staff resources on sort of the new ones, right? So right now, staff is spending all their time on all of them, and things get sort of stuck on people's desks. And my fear is that, as Reena mentioned, we're the envy of the world in terms of the capital markets, but if we over-regulate, if we slow things down too much, the rest of the world's catching up. And so what we need to do is be nimble, and one way to do that is to move a lot of the approval process to a rulemaking that basically the presumption is you will be approved as long as you do these certain things, regularize that, and then staff can spend their time on the more esoteric, the new stuff that perhaps is going to provide new innovation, new ways for investors to invest in different types of asset classes.
All right. Well, thank you so much. This has been extraordinarily helpful. So let's give Commissioner Piwowar a solid round of thanks.